In 1965, a failing textile mill in New Bedford, Massachusetts was hemorrhaging money. Its machines were outdated. Its workers were worried. Its future looked over. A young investor named Warren Buffett had just taken control of it. If you told anyone in that room that this dying company would one day become the parent of a $1 trillion empire, they would have laughed you out of the building. This is the story of Berkshire Hathaway and how the worst investment Buffett ever made became the vehicle for the greatest wealth-building machine in modern history. Welcome back to Master Investor Mindsetter. Today we're going deep into the origin story every value investor should know because it's not really a story about textiles. It's a story about capital allocation, patience, and knowing when to let go of a dying business model. And by the end, we'll connect it to what Indian investors, especially SIP and long-term Nifty investors, can learn from it. Let's rewind the clock. Berkshire Hathaway wasn't born as an investment company. It was born in 1955, from the merger of two old New England textile firms, Berkshire Fine Spinning Associates and Hathaway Manufacturing. Textiles had once been the backbone of the American Northeast economy. Massive mills, thousands of workers, and steady demand for cotton and wool products. But by the 1950s and 60s, that world was collapsing. Cheaper labor in the American South, and increasingly overseas, made northern textile mills brutally uncompetitive. Profit margins were razor thin. The industry was shrinking every year. Enter Warren Buffett. In the early 1960s, Buffett was running his investment partnership, hunting for what he called cigar butt stocks, companies trading so cheap, below their liquidation value, that even a struggling business had one last puff of value left in it. Berkshire Hathaway fit that description perfectly. Its stock was trading for less than its working capital. Buffett started buying shares quietly. Then came a moment that, by his own admission decades later, cost him billions. In 1964, Berkshire's management made a verbal tender offer to buy back Buffett's shares at $11.50. Buffett agreed. But when the written offer arrived, it was for $11.375, an eighth of a dollar lower. Buffett was furious. Instead of selling, he did the opposite. He bought more shares, took control of the company, and fired the executive who'd tried to shortchange him. He later called this decision, driven by emotion rather than logic, one of the costliest mistakes of his career because he just poured capital into a dying industry out of spite. For the next 2 decades, Buffett tried to make the textile business work. He invested in new machinery. He worked with capable managers like Ken Chase. But the fundamental economics never improved. Foreign competition kept undercutting prices. Domestic demand kept shrinking. By the mid-1980s, Buffett made the call that separates great investors from stubborn ones. He shut the textile operations down completely in 1985. Here's the lesson worth pausing on. Buffett didn't fall in love with the business. He fell in love with the numbers, and when the numbers stopped working, he walked away even though it meant admitting the original purchase was a mistake. This is a mindset every retail investor, whether you're trading on the NSE, holding SIPs, or watching Nifty charts, needs to internalize. Loyalty to a falling asset is not conviction, it's often just ego. But here's where the real story begins. While the textile mill was struggling, Buffett was quietly using it as a shell, a legal structure with cash flow to acquire something far more powerful: insurance companies. In 1967, Berkshire acquired National Indemnity Company. This single move changed everything. Insurance companies collect premiums up front and pay out claims later. In the meantime, that premium money, called float, sits with the insurer and can be invested. Buffett realized he had access to a massive, low-cost pool of investable capital that kept growing every year. He used that float to buy stakes in companies like GEICO, See's Candies, The Washington Post, and later Coca-Cola and American Express. Each acquisition generated more cash flow, which funded more acquisitions, which generated more float, which funded more acquisitions. This is the compounding machine that turned a dying textile company into Berkshire Hathaway, the conglomerate we know today, encompassing railroads like BNSF, energy companies, Apple stock, and dozens of wholly owned businesses. From a stock trading around $19 a share in 1965, Berkshire's Class A shares have grown to command a valuation crossing the $1 trillion mark in market capitalization, one of the greatest wealth compounding stories in financial history. Now here's why this matters if you're investing out of Mumbai, Bengaluru, or anywhere in India. Berkshire's transformation wasn't about picking one lucky stock. It was about redirecting capital from a dying business into productive, cash-generating assets consistently, patiently, over 60 years. That's precisely the philosophy behind a disciplined SIP into a Nifty 50 index fund, or a long-term F&O free equity portfolio. SEBI's own data has repeatedly shown that the vast majority of retail F&O traders lose money chasing short-term speculation, the exact opposite of what made Berkshire work. Buffett didn't day trade Berkshire's textile stock. He restructured the underlying business for long-term compounding. Indian investors chasing quick options premiums on Bank Nifty each week are, in Buffett's own words, treating the market like a casino, not an ownership stake in real businesses. So what's the real takeaway from struggling textile mill to trillion-dollar empire? One, a bad initial investment doesn't have to be a permanent one, if you're willing to admit the mistake and pivot the capital. 2, cash flow machines, like insurance float for Buffett, or steady SIP contributions for retail investors, compound far more powerfully than one-time bets. 3, patience over decades, not months, is what actually builds trillion-dollar outcomes. Berkshire Hathaway today owns everything from Duracell batteries to Dairy Queen, from BNSF Railroad to a massive stake in Apple. None of that would exist if Buffett had stubbornly kept pouring money into looms and spinning machines. The textile mill is long gone. But the name lives on as one of the most valuable companies on earth. If you found this story valuable, hit subscribe for more deep dives into the minds of legendary investors like Buffett and Munger, and let me know in the comments, what's the biggest, sunk cost, mistake you've had to walk away from in your own investing journey? See you in the next one.